Thank you for joining us for a mid-quarter update. We have a lot to cover, so let's dive in. For the quarter, global stock markets have increased 4%, with small companies and emerging markets leading the pack, a classic sign of a risk-on environment by investors. Now, year to date, all stock markets that we track are positive for the year, with international up more than 20%. Bonds are higher for the quarter, with those most sensitive to the economy, high-yield bonds, leading the charge. Now, the picture with commodities is more mixed due to oil's weakness, sensitivity to tariffs, and geopolitics, while Bitcoin continues to rise. We have the current yield curve here in blue. In red is from 1 month ago, and in green is from 3 months ago. And now what's important to note is that the market's expectations for rate cuts have increased meaningfully. Now, compared to 1 and 3 months ago, investors are now seeing more cuts coming sooner. And that's reflected in the yield curve, which the short end has declined while the long end hasn't moved much, suggesting that the market believes the Fed will act to support growth. Now, with expectations of lower interest rates, this quarter, investors leaned into risk. That's why sectors like consumer discretionary and communication services have led the way. Now, people are starting to spend, and they're spending on streaming. Meanwhile, defensive sectors like healthcare and consumer staples have lagged. It's a classic rotation. When rates are expected to head lower, growth often gets rewarded first. Now, lower rates tend to help smaller companies more than larger ones. And that's exactly what we're seeing in stock prices. Small and value stocks are outperforming, especially here in August, while the AI-driven mega caps have cooled off this month. And it's a sign that investors are diversifying their U.S. bets beyond just technology. Now, the yield curve dropped shortly after the surprisingly weak jobs report. That put the Fed in a tough spot. Job growth is soft, especially industries outside of healthcare, and inflation hasn't cooled as much as hoped. And that's why the Fed has been calculating. They want to support employment, but they can't ignore that inflation is in the data. And inflation is showing up in goods, medical services, and transportation. Now, while goods may be impacted by tariffs, medical services and transportation are areas where prices are sticky and they're hard to reverse. And it's a reminder that inflation can quickly embed in everyday services and in supply chains. Now, while consumers continue to spend on essentials and travel, they are pulling back on many discretionary categories. This reflects the bifurcation that we've talked about. Secure consumers are still spending, but stretched households are feeling the pinch. Now, big companies are navigating this slowing growth, sticky inflation environment better than others. Large companies, which are here in red, those outside of the Mag 7 even, are showing signs of earnings growth. They've managed costs well, and they've adapted to slower demand. And it's a sign that scale and discipline matter in this environment. And that's not all growth is going to be tech-driven growth. At the same time, smaller companies, which are here in green, they have struggled to grow earnings. In the first half of the year, we talked about why we added commodities to portfolios, as we believe we're moving into a more volatile period. Outside of oil, commodities have generally held up pretty well, despite global uncertainty. As we wrote in our second quarter letter, we believe we're in a period that we're calling the end of the era of easy. No more easy money, easy growth, or easy decisions. And that's why diversification and flexibility are key. Interest rates adjusted for inflation have returned to a range in line with the decades before the global financial crisis. In this environment, we believe a broadly exposed portfolio is likely to outperform. With that, here are the portfolio changes that we've been analyzing and considering. We've been researching increased exposure to utilities. It's both a defensive sector, but with the build out of AI infrastructure, growth in power demand and company earnings may accelerate to rates that we haven't seen in decades for utilities. We're also analyzing changing our fixed income portfolios to favor shorter duration or less interest rate sensitive and inflation sensitive assets. The goal is to stay flexible and thoughtful, not reactive. I'm Simeon Wallis, Aprio's Chief Investment Officer. Please reach out to your Aprio Wealth Advisor or to me if you'd like to discuss further. We're always here to help.